Good morning to everyone joining us. We are very thankful that you'd make the time to be with us this morning. My name is Bansi Kaleli. I work with Equities Financial Services. I'll be moderating this session in partnership with Brian Bogomin. I'll request Brian to say hello.
Hello, good morning.
Good morning, Brian.
Okay, so I think we'll get started. The purpose of today's session is to look at the impact of COVID-19 on retirement benefit schemes and also the financial markets. And before we get started, I just want to know what people are feeling. I'm sure most of us, if not all of us, are working from home. So what has been your experience during the lockdown? Are you ready and eager to go back to work? Or are you enjoying time with the family? Or are you not sure? So you should see a poll on your screen. Just click on the answer and then we'll get started. I'll give us another 30 seconds.
It's not responding.
You can see 71% of us have responded. Another 10 seconds for the people yet to respond so that you can know who's in the room. Okay, let me end it. I don't know whether you can see the results on your end. I think majority of us, 53% of us, are somewhat enjoying staying at home. I bet that, okay, it's funny today, the entire panel is composed of men. So I don't know what the men are feeling. Are you the ones who are not enjoying and you want to go back to work?
That's not a fair...
It's not a fair assessment. All right, let me not judge and let's get started then.
Men are also enjoying staying at home.
Okay.
I believe. And who says men cannot enjoy staying at home?
No one.
And I confirm with George Mulindwa there. He looks even more relaxed than the last time I knew him. I said, yeah. And thank you, Martin, for joining. We are very grateful that you are on board. Yes.
Yeah, it's a good time.
Okay. All right, so I think we should get started on our first session because you don't have too much time and we really want for you to participate, to ask all the questions you might have. And as Simon has said, you're really honored to have Ubra participating in this. So if there are any questions that you have, we want to give you enough time to ask and get your answers. So our first speaker is Mr. Simon Afubwa. Simon is the Executive Director, Equities Financial Services. This is the fastest growing and most innovative and customer-centric pension administration firm with offices and presence in Kenya, Uganda, and Mauritius, but serving over 12 other countries with over 620 million USD in assets under administration. So Simon, I'll request you to start your presentation. You may share your screen.
Just a minute, Pansy. As I get to share. Yeah,
okay. Just as Simon is doing that, maybe some guidance for the participants. If you have a question, feel free to write it under the Q&A platform. We will try and answer as many as those during the webinar. You might also use the raise hand function. On your screen, you should see a hand, and I can see a few people already raise their hands. So you may use that if you want to speak. We will give you opportunities to speak at the end of each presentation.
Maybe someone has a burning one as I just get to open my slide.
Okay.
Opened, yeah.
All right. Oh, you raised, the people who had raised their hands look like you lowered them. If you have something that you need to say, feel free to raise your hand. We may give you an opportunity as we wait to get started.
Okay, I think I'm good.
You're good?
So
okay.
Once again, really honored and privileged to have those who joined us this morning. And we are very grateful to have the CEO of UBRA. UBRA is a great partner, very supportive in terms of industry engagement, led by the CEO, Mr.Martin and Nsubuga, who we are very grateful and quite honored to join and be part of this panel. We thought that even in this lockdown period, we think that our time is not quite locked up, our information, our knowledge is not locked up. Our retirement, we can still use this lockdown period to unlock the value of our retirement planning. And the best way to get started is just to share information that can help us plan well, respond positively without panicking, and being reactionary in this season of COVID-19. And so in my presentation this morning, just in about 15 minutes, I will talk about risk and compliance and funding and benefits and scheme operations in relation to how then the COVID-19 would be impacting the operations of the scheme. And our view is that trustees and sponsors of retirement benefit schemes, and together with all the stakeholders, the service providers, even the regulators, may look at in the very short term, in the immediate term, what are some of the key areas of priority to look at, analyze the impact of COVID-19, and put some bit of action item around it in response to that. And same as also medium term in terms of adaptability, and also long term from an alignment perspective. But even before then, perhaps it's just to identify then do some bit of analytics to check what are some of the areas you might be affected, identify those areas, analyze the likely impact and measure the likely impact, and put a framework of action in response to the emerging issues as a result of COVID-19. And so what we've done is to attempt to share a bit of what we think could be just as a starting. And some of the areas in the immediate term that could be affected by COVID-19 is investment management. And I'm sure Judge Mulindwa is going to talk a lot more on that. But our view is that trustees are likely required to review with the guidance of their fund manager. What are some of the sectors of the economy that might be affected by COVID-19, and in what way trustees can position themselves to benefit from the opportunities arising? Because not everything is negative, actually. Even in challenging times, there are also strong opportunities that if we carefully look with a professional eye, we can be able to mine value out of those opportunities. But coupled with that are underlying investment related risks that with the guidance again with the fund manager, trustees need to review. I don't think this is the time to wait until you have quarterly reports because so much is changing daily. I woke up this morning with news. Mauritian Airline has been placed under administration. I also saw the other day another 2 airlines have placed under administration. So there is a lot of changes that are happening. Hospitality sector is quite impacted negatively. So what does this mean if you are a sponsor in the hospitality sector? In terms of funding of contributions, and even in terms of institutions that are listed in the stock market, which are playing in that segment of hospitality sector. A lot is changing, and our view is constant engagement with the trustees and the service providers to see how well do we position ourselves to minimize risks that would impact negatively on the pension funds, and also safeguarding the interests of the members in the pension scheme. I also want to reiterate the point that COVID-19 or no COVID-19, the fiduciary responsibility of the trustees does not change. And I'm sure the CEO of UBRA is going to echo that perspective. all we can do is to try and play within the situation, just to ensure that we also still remain compliant. Might be also helpful for schemes that have their investment with insurance companies, we call them guaranteed funds, might be helpful to check the clauses on exclusions as to whether the current policy terms, do they exclude pandemics? We have had cases where insurance companies will give minimum guarantee, but in such situations like COVID-19, they come back and say, no, this exclusion will apply, and therefore we can't hold the minimum guarantee we've given. Might also be helpful to cross-check, so how relevant and realistic are the investment performance benchmarks that have been provided in the investment policy. So those are some of the key issues we would bring out in relation to investment management. As regards to funding, it will be helpful to assess the going concern of the employers who have put in place retirement benefit schemes. Remember, pension schemes would arise out of a contractual obligation from the employment relationship between the employer and the employer, where we have occupational pension schemes. But in the event of inability for the employer to continue in their operations, then obviously it means that employees might be laid off, and that would then mean that we have the necessity to pay out. That would then require cash flow modeling from the view that no contribution might be expected, and also a lot of payout would then need to happen, and that would require then liquidity. Tacked alongside that, it means then that engagement with the fund manager to know what kind of asset classes will have to be liquidated to avoid liquidating assets at a loss while they are providing liquidity for members who are exiting. Some employers might also want to review their contribution rates, and our view is that might be extremely important to engage the legal mind, the professionals in the legal sector on labor laws, and also the legal minds on the retirement benefit sector to be well guided. Of course, that cannot happen without the approval of the authority, and the regulator has to be involved. Of course, where there is necessity, guided by a qualified actuary to review the actuarial assumptions in the context of defined benefit scheme, where the benefits are based on service and then the accrued pension factor and the final pensionable salary, then again, any scheme adjustment on the actuarial assumptions would require also the approval of the regulator, and we then need also to go through the requisite process. From the member engagement and scheme operations, there is a lot more need to engage the member instead of doing annual engagements or through the annual general meetings. I think there is need and urgency to even do a memo, a bulletin, to just alert the member that, by the way, this is how COVID-19 is impacting on our investment within the pension scheme, and this is the remedial action plans as trustees with the fund manager we are undertaking in response to the opportunities and also challenges arising out of COVID-19. But also, we've seen the custodial banks now bringing on board the indemnity for online payment instructions. It might be helpful to see that the same is reinforced within the contractual terms. The other key thing that we would also want to urge trustees is that in a depressed market, it might be helpful to urge the members to defer access of benefits at a later stage when the markets have done recovery, to avoid crystallizing of losses. Still, again, on the same context, is extremely important to check on the income allocation policies. At such times, if the schemes are doing, say, negative investment returns and the interim payouts are at 0%, ideally then what we are doing in defined contribution basis we are then overpaying, and may be helpful again to cross-check the reality of the income allocation and their impact on the members who are left. And finally, on governance, I think it's important to check the analysis of potential compliance risks so that potentially engage the regulator. And I'm grateful that UBRA has taken a very proactive role in sharing and communicating with the industry on with some guidelines that I have also gone through. And I'm sure the CEO UBRA is going to comment a lot more on that. Now, meetings used to happen physically. You greet your fellow trustee, you could hug them, and now you can only wave through Zoom. So again, online channels of communication would then be the new norm. Perhaps communication policies that appreciate these opportunities going forward. And of course, much as there are opportunities, cybersecurity confidentiality risks are now at an all-time high, and it could be another area of focus and potential need of assessment to put in place much more stronger ICT security infrastructures that safeguard confidentiality of member information, and also protecting the scheme from any form of cyber security attacks and also frauds. Long-term diversification, if really there is material need, then you may want to relook at investment policy. If you are doing asset transfer from one scheme to another, you might want to check, so when you are transferring, what are the opportunities in terms of the new scheme you're transferring to? Let me put this in perspective. So if you're transferring from a guaranteed scheme to a guaranteed fund to a segregated fund, hopefully at this point you are transferring, you may be well positioned to buy shares cheaply, and therefore when they rally up, you have an opportunity for capital gains at a later stage. But it may be helpful with the guidance of the fund manager, a deep analysis on asset transfer at this point, and how you realign the portfolio structure to optimize investment returns from the perspective of the asset mix. Funding, I think, assess the sponsor going concern in need with the guidance of the actuary, and also subject to the approval of the regulator, review of the actuarial assumptions for defined benefit scheme, and a mini actuarial evaluation just to check on the sustainability of the funding level of the scheme. And then, of course, might also be helpful from a risk compliance and governance to do a COVID-19 risk register, aligned register, and see in the next 3 months or 1 year, how do we align ourselves into the future. At a personal level, on a personal finance level, I was just thinking that since you have a lot of time at home, why can't you take time and do the perspective of SWOT analysis, your strengths, your weakness, your opportunities, your threats, but from 4 dimensions: capital, your social capital dimension, your financial capital dimension, your career and perspective, and family and social, and also spiritual, and your overall well-being. After you've done that, might be helpful that you develop some opportunities in terms of goals, and which then can impact on your income ability, either as an employee or as a business owner, and also which can also be aligned in terms of your spending behavior, so that this should be an opportunity for us to unlearn the way we've been managing our personal finances, so that the lessons we carry from the COVID-19 situation, we cannot, if we have another situation, God forbid, of COVID-19, we use this moment to overcome the future challenges that we. And then, of course, perhaps redefine your financial future by enhancing your ability to grow your wealth into your future. So as I close, I leave you with this: reform your current financial future now by having a personal wealth creation plan. Play resilient. If you have ever driven through a muddy place, you don't go slow. You push through resilience. In fact, you reverse a little bit and drive very quickly. That's called resilience. And you don't respond to challenging times by way of fear. Sanitize your finances from wasteful expenditure. Flatten the curve of your expenses, unnecessary expenses, and then lock down your expenditure budget within your income ability. With that, I want to thank you so much. And Bansi, over to you. I could take one or two questions, Bansi.
Okay. Thank you so much, Simon. It was a very insightful training and content. I'll request the participants, if you have a question, just raise your hand and I'll pick on you to speak, or you can write it on the Q&A platform. So I'll give us a minute. If you have any questions, require any clarification. And even to the rest of the panelists, if you'd like to add to anything that Simon has said, please feel free to unmute your speakers and share your insights.
Okay. Any?
I think I'll share my views when I'm making my submission. There are a few issues that are cross-cutting, so not to preempt what I'm going to talk about, let me reserve that when I submit.
Okay. I see Timothy has raised his hand. So Timothy, please unmute your speaker and ask your question.
Thank you, Simon. And this has been very insightful, and thank you everyone for putting this together, especially NWealth.
Thank
and
you.
for Mr. Nsubuga for accepting to join this forum. Just to get clarity from Simon, he said that the sponsors, because I'm speaking now on behalf of a sponsor, the sponsors can find a way of deferring their contributions in case they are facing a cash flow problem. The way sort of NSSF has given the, they've told the employers, if you think you're going to have a cash flow problem, get in touch with us, then we can work out an arrangement. So does that option also, is it available for sponsors who are making contributions, their own contributions, not the employees' contributions in this regard? And also, if would it also be extended to the employee contributions? So can that arrangement be worked out between the sponsors and the regulator? Thank you.
What I mentioned is that might be helpful for trustees to assess the going concern of the employer, because you get contribution from the employer, and if there is need, then it's extremely important to engage the regulator for necessary guidance. But I'm sure the CEO Ubra is going to comment on that in his presentation. Okay. And also Brian, at Brian, you may also comment on that.
I think we shall wait for CEO to comment, then we can react to it.
Okay, thank you.
Thank you. Then I'll take the last question from Amani. Amani, if you may please ask your question.
Okay, thank you very much. Thank you all for organizing this platform. I have a question and a comment that I want to make. The question is about this pandemic. I would like to know what are the expected ripple effects on the retirement scheme arrangements, given that we expect a dramatic increase in unemployment, closures of some businesses, unless maybe government steps in. So what may be the ripple effects to the retirement arrangements? Then the comment that I would like to make is on the guaranteed schemes. I work with ICA, and we run a deposit administration policy, which has a 5% guaranteed interest. And for this guaranteed arrangement, we also, we still maintain to give the 5% regardless of this pandemic. Therefore, the members' return on investment is at least assured.
Okay, great.
5%.
Thank you, Amani. Grateful for that. So I think in terms of the holistic impact, you are going to get it through all the presentations so as you listen through, you'll be able to pick every section of the impact of COVID-19 in the pension scheme, which I've already done part of it. And the remainder, we can sum it up in the course of the presentations. Fancy, over to you.
Thank you, Simon. I think, thank you for the very good presentation. I think we'll move over to the next presentation. And I'd like to invite Mr. Martin Nsubuga. He's the Chief Executive Officer, Uganda Retirement Benefits Authority. I'm sure most of us know him, but just in brief from his bio, Mr. Nsubuga has been pivotal in the development and implementation of a robust and supervisory framework with close to 15 years at the Ministry of Finance, Planning and Economic Development, and working in different capacities. He's initiated policy and regulatory reforms in insurance, pensions, and the capital markets. If you just give me a minute, I will start sharing his presentation. But sir, you might say hi to the participants.
Yes, thank you. Thank you, Nancy, and thank you, NWF, for organizing this very important webinar. And I want to thank everybody for bearing the constraints that we are facing working from home, and of course the COVID. It's not quite very easy, but at least for those who have continued to serve the nation and the public, thank you so much. I'll straight away go through my short presentation. It is quite short. The presentation is just to provide my talking notes, but I thought we need to begin with the trend of events, how it has unfolded, such that we can have a rationale of where we are coming from, and then start to think through whether we're really coming from very far or it's just a recent thing. Well, we started from March, when the COVID, that was 11th March, I think, when the WHO announced the COVID, that it's a pandemic, and subsequently we had preventive measures announced by His Excellency the President and the Minister of Health. Then we went on to have, again in March, a reaction. I don't think it was a reaction by Bank of Uganda, but rather a response, probably suspending bonus and dividend payments by commercial banks. We know very well we have equities for some of our schemes in the financial sector. But again, we also saw a reduction in the CBR rate from 9 to 8%. In March 23rd and 26th, we issued 2 public notices. Ours were mainly for precautionary measures to avoid the contacts, to emphasize the social distancing. Ideally, we suspended most of our engagements. We even advised schemes that are arranged for their annual general meetings during that time to suspend their engagements until a further notice. We thought it was quite a short-term thing, but then we had a lockdown for 14 days on 31st March, and another lockdown for 21 days, 14th March. So we're talking of a period of not more than 2 months, but the effects are quite substantial, as we shall see ahead, and the likely implications are quite substantial. From the economic perspective, I think we also need to touch base what it means entirely. The numbers here are not necessarily COVID-related, but at least they reflect where we are coming from. The Bank of Uganda announced just in March, end of March, the projections for GDP economic growth as a country will slow down to 4%. We are targeted 6%. It's important to note that we are not in a recession as yet, but it's a slowdown growth for now, and that's what the numbers indicate. We've begun to anticipate reduced aggregate demand because of the purchasing power has been impaired. Aggregate supply, productivity has been impaired for this period in time. So we are likely to have ripple effects. So probably even the numbers that are anticipated for growth may be revised along the way. But we are looking at growth for the financial that is ending June. Maybe the numbers beyond June may be affected further. Our shilling has been impaired again with steady depreciation of 2.2% between February and March 2020. Financial market, that's the capital markets, has had significant volatility, particularly in the equities market. We know what has happened in Kenya. I'll mention something about it. But we have a lot of equities in the Ugandan market that are of Kenyan equities in our Ugandan market, in our retirement benefit schemes that are invested largely in the Kenyan market. We know the Kenyan breweries has serious effects. We know Equity Bank, we have substantial shares there. And Safaricom, fortunately, I think Safaricom, much as it has a few issues, it's still doing very well. And I think they're in business. We are using a lot of data. I'm told telecom companies are really making quite substantial amount of money during this period in time. But I'll leave that to George. He's the authority at this. Just trying to raise a few economic perspective. So what do we then see from the implications from our side as the sector? Quite a number. Simon has mentioned a few of them, but I'll begin. There are quite a number of them. I've attempted to categorize them in three sets. That is, there are those of a supervisory nature, there are those for scheme administration, and there are those that are probably for the fund management side. So what do we see? I think also to address a question that has been asked. First and foremost, these are all assumptions. They have not yet confirmed, but we anticipate these are likely things that may happen. They may not happen. Like I've said, we are looking at a period that is beginning not so long ago, just recently in March, April. So we cannot fully go into the future and anticipate all these that are going to happen, but there are things that we need to consider. So from our side, we think there's going to be a likely decline in the average growth rate of the pension funds, mainly because of two factors. These pension funds growth is mainly driven by growth in new contributions as members, and of course the income that is made from the market. Like I've said, we are likely to have some implications from the equity side regarding the flows or the incomes from that side. Government securities, probably not so much. Like the slide I'll show you later. We have around, I think 75% of our portfolio is in government securities, and only 15% is in equities. So the two account for 90%. So the CBR rate, will it have a big impact in our market as yet? Probably on our side, we've not yet anticipated a significant impact as yet because of the nature of our market. Assets are held to maturity and there's quite a huge stock that has been held for a long term. So the current CBR may not likely affect. But again, the responsiveness of the market regarding the CBR is not a reduction in the yields, but in sometimes an increase in the yields that we've seen in the recent auction of last week. The second one, under supervisory implication, we're likely to see delayed submission of statutory returns. We are receiving calls from our stakeholders. They will not be able to submit their financial returns. Those are the audited ones that we normally receive around this time. However, for those quarterly returns, much as a few are having a few challenges, the majority are being held at respect or to honor their responsibilities. the quarterly returns, the few calls I've received from fund managers and administrators and custodians, because they're operating remotely, they say for these ones, they'll be able to honor. So there's no serious concern. But again, we can handle one-on-one if there are issues that can be raised by a respective agency or stakeholder. The third one, from the supervisory side, we are likely to see delays or decline in remittances of contribution. I think Simon has mentioned this. It's not an issue of going concern of the sponsors, but rather, I mean, a disorganization in their cash flows and operations. And a number of our occupational schemes are in the banking side and also on the production side. And you know very well, because of this lockdown, production has been low. So you're likely to have a few issues there about. Under scheme administration, yes, we see unscheduled or unplanned payouts, agitations. I think I've made a comment on this in the media. But again, as we see this, we are likely to see more demands from the market. And of course, from those on the occupational side and those from the mandatory scheme like NSSF, the treatment can be quite different, but the agitations are going to be there. Our fears, again, are likely loss of employment. And if there's a loss of employment in this market, because of the mindset the occupational schemes have, people run for their benefits immediately. They don't want to hold them there to grow, but they rather get them and move on. The other fear that we have, the possible loss of trained trustees. Remember, we began a journey of 7 years training trustees, enhancing their competences and capacities, and we see a level of understanding of this sector, and members and the trustees are upholding their fiduciary responsibilities, and they are really improving day by day, year after year. Now, a loss of one or two of these trained trustees has a serious impact to our market. On the fund management rates, which I know George will be able to handle very well, I've mentioned about the volatility in the equities market. It's a threat we see, and it has a serious impact. But we do not think that this is going to be for a long time. Probably it is of a short-term nature. We also anticipate there's this concentration of asset classes in government securities and equities. We anticipate a revision in IPSs. For those who have received our communications, there are IPSs that were supposed to be revised, and a number of schemes have actually revised their IPSs, but we anticipate a new set of revision of their IPSs because of what is happening now. And if you think through into the future. Market yields, because of the economic downturn and then non-performance of some fundamentals in the economy, I think we are likely to see a demand on financing of the budget from the government because of our revenues may not perform as anticipated, and subsequently we may even see more high yields. Of course, from our side, it could be, well, an attractive thing, an opportunity, but of course it has some implication depending on how you treat your accounts. If you're holding to maturity, yes, it's an opportunity. If you're holding to sell, fortunately, you don't have many that hold to sell that would have that implication of increase in the yield to affect their value. We've not seen that. This is in light of the current portfolio is just to share with you how you are faring, how you are investing, and the concentration. I think I've already mentioned this, but government securities have a concept. I've said they already account for 75% of of our portfolio, and then equities account for 15. Effect are probably on unquoted equities, and they're growing strongly. Remember, had they almost less than 1 percentage point. We are talking of about 2.5. We don't anticipate much. So the focus is any variation into that. That's when we shall have a significant impact. But because of the economic trends, we are probably can say that the portfolio is kind of immunized in one way or another because of the concentration of government securities today and less in equities. But can we say that this is for the long-term future? Probably not. Can we say that this can be a savior for the sector for now? Probably. For now, yes. But for the future, we cannot anticipate for how long. As WUBRA, we've come up with a few measures that we think can be able to support this crisis. Like I've said earlier, we cannot anticipate. I think, Nancy, you can help me. I cannot move this slide. You can move from exactly. Thank you so much, Nancy. We've agreed to say that we shall continue to provide guidance on a case by case. We've been doing that ever since this problem started. We've been providing guidance on one-on-one to scheme, educating members on what they're supposed to do. We've also issued a notice this week extending the submission of audited financial statements for 1 month. It is anticipation that the lockdown will probably end as anticipated in 5th of May, and therefore, by the end of May, schemes that would not have submitted their audited financial statements may be able to complete them, and auditors would have all the evidence they need to finalize their final accounts. Again, we've in that statement that is already on our website, we've provided a window for schemes that may have challenges with their sponsors in terms of having constraints in meeting their contribution obligation, that is of employer and employee. And then we can have a one-on-one discussion. We cannot issue a blanket extension or a blanket consideration for all, because it is not affecting all entities across. But those who are going to be facing challenges, we've created a platform. You can approach us, and then we can find a way to address that for a period of 6 months. And then, but the most critical thing, the sponsor must provide assurance that there's a going concern, there's no threat to the going concern, but rather they are only having a shortcoming in this period in time, which will be rectified in future. If it is a permanent problem that is likely to cause a few issues, probably causing a serious impact on the scheme, again, we are able to listen to that. Fortunately, our new regulations that we've issued 2 regulations that are new. One is on mergers and winding up. It is a very good one that can help schemes with those considerations, but it is our desire that no scheme is closing, no scheme is winding up, and we anticipate that all of them will continue. And we think that an exit, a delayed contribution of a sponsor does not necessarily mean that the scheme should wind up. We are continuing to engage fund managers to establish their strategic measures to minimize these risks. Again, this platform is very good. George will allude more on that. But we've engaged them. They've provided more insights on how the market is faring. Some have actually ahead of the game with the strategic measures in terms of asset classification, moving assets from one asset class into a secure one. Scheme administrators, we appreciate the risks, but we've been engaging them again, but we need to enhance that one more. Where we've not done much is addressing complaints, because Much as we've created the online platform for submission of online complaints, people prefer to move into our offices or to write official and communicate. We've not seen many of those. The few we've received, we've been able to handle. Those that were still outstanding, we've not been able to resolve because where the delays are coming from, particularly on the sponsors, some the active staff that are responsible are not in office to help us resolve some of the complaints. So in summary, those are the things we've been able to address, but we continue to monitor this. We continue to watch it, but what we cannot anticipate for sure is how long this is going to take. But we can only anticipate that in the short term, the few measures we put in place, but we also don't anticipate that the going concern of schemes is going to be impacted in this short term. We don't anticipate that. Of course, after end of this year, maybe we can see how things unfold. In summary, that's what I wanted to share in this short time I had. Thank you for your attention.
Thank you so much, Mr. Nsubuga. I'll request that if you have any participants who have questions, raise your hand and we'll give you an opportunity to speak. But in the meantime, I'll read some questions in the Q&A platform. We have Juliet Josephine who asks, thank you, Mr. Nsubuga, for the insights. My questions are, number one, has UBRA issued any guidance or waivers on statutory returns and other statutory requirements? And then the second question is, are you aware of any funds that have confirmed remittance deadlines by members or negotiated terms? Then she also asks that you share with us a copy of the notices issued by UBRA thus far.
I respond to those of statutory returns for it is very much accessible. Have we received any scheme that has requested for delayed contribution? For now, no, officially. But we receive like is that we need to dig through the reduction in contribution, or is it because we need to take a decision on that, we need an assurance from the sponsor such that we can have a plan thereafter. If it's a delayed a meeting of contributions, say for 2 months, we need an assurance from the sponsor that this will be honored thereafter. So on one-on-one, we are engaging them, but we've opened now the window from our side for official communication from different schemes and sponsors, which anticipate. So you need to come up with clear evidence that there is a serious evidence, there's a serious problem that needs to be addressed.
Okay, thank you, sir. I think I'll allow Hajat Sabiela to speak. Please go ahead. Hajat?
Hello, do you hear me? Hello? Hello, do you hear me?
Yes,
morning.
Morning.
Yes, I would like to thank NWealth for organizing this, and I'm very happy that I'm actually attending. I am a saver. I save with 2 schemes, but I want to understand how the administrator and the regulator will push to ensure that the trustees keep us members informed of the status of our the funds. I just want to see what can they do to make sure that we are informed of the effects on our savings by this pandemic. Thank you very much.
Thank you. I think Simon emphasized the issue of fiduciary responsibilities, and the trustees at this point in time are not disarmed from their responsibilities, whether COVID or without COVID. Again, the most critical thing is to continue communicating. We've already created platforms and requirements for trustees to engage their members and to communicate to them. Maybe most of the schemes have not developed to the level of having a platform like this to communicate to their members, but I still think that most of us, all of them, have mobile phones, so they could use a simple one like WhatsApp and communicate any new developments, any new fears, and probably get more information from their stakeholders. I think from our side as a regulator, there's no way we can come up with a guideline or a policy how they can communicate. We can only encourage, and it is already provided in one of our guidelines. Trustees are supposed to continue communicating to their members of any developments, and it is more important even during this time round. Administrators do that. I don't know how they do it, but we believe that they engage the schemes under the administration and support that process. Where it is not happening, I just want to encourage the administrators and other trustees on this platform, on this webinar. Please engage your members, communicate to them of any developments, of any risks that are likely to harm, such that they are not surprised when things happen. Engaging and communication is very critical.
Thank you,
and
sir.
just to add on, and that's a very great question, is that, for example, we as NWELT, we have an online portal through which we engage our members, and they can access their statements online wherever they are, even through the mobile app. And we know that also we engage for those in our umbrella fund. We do bulk SMS texting to them to just keep them engaging. The member is a primary key stakeholder in any pension scheme. And so that's a very valid question. From our end, we are working out a small memo to each member with the approval of the respective trustees to just update them on the implications of COVID-19 and some of the key concerns that they need just to be aware of, not to scare them, but just to keep them informed as we continue to look after their funds. Thank you. Bansi, over to you.
All right. I think I'll read one more question and then we'll move over to the next presentation. So we have Mr. Ben Meta who asks if a sponsor suspends contribution due to temporary closure, including no payment of wages, stroke salary to employees, and expects to open shop later, will they be obligated to pay those contributions at a time or will it be forgone? So when the employer opens operations, and I see this question has also been asked by Amani, especially when you're thinking about the hospitality industry. So when they reopen, will they be required to pay the contributions then, or will they be forgone?
Yes, our understanding is that all the trust deeds we have, even the Act, do not talk of cancelling contribution. You can delay making contribution. If at all we've had an engagement and we've agreed on the methodology that is going to be handled, it's just going to be a postponement of making contribution, but not a cancellation. And that means once the situation normalizes for any sponsor, it means that they have to honor the obligation of the past. Maybe the discussion or the question would be, how would they account for the, say, the interest that may have been lost during that period in time? But those are now the discussion that can be considered. But the issue here is that contributions are not cancelled, but may rather be postponed or suspended for some time, but must be honored once the situation normalizes.
Thank you for the clarification.
Thank you, Nancy.
and for the insightful presentation. I think I'll move over to the next and final presentation. We are running a bit behind on time, so I request the participants if you can just give us a few more minutes so that we can hear from the fund management, especially on investments and what to expect, and then we'll be done. So we have Mr. George Mulindwa from GenAfrica Asset Managers, who will be speaking to us about the impact of COVID-19 on the financial markets. George is the country representative of GenAfrica. He also doubles as an investment manager in charge of fixed income and equities. George is a CFA charter holder with experience in financial services spanning over 10 years. He has been involved in the management of retirement funds for the past 5 years, both in business development and portfolio management. George, I'll request you to share your screen and start your presentation. Welcome.
Thank you, Bansi. Good morning, everyone. I'll just get right into what I have to share this morning. Bansi, you just confirm if I am audible enough.
You're audible, we can hear you.
Okay. Where we are seated, we thought it was important to start to look at the impact of COVID from an Africa-wide perspective, then the region, the country, and we'll look at the portfolio. In the time I have allocated to me, I will manage that to the best of my ability to get to how your scheme could be affected by the pandemic that is ongoing. So what we did was really to pick a sample of the region, but also two other, bigger economies within Africa to see how they have responded to this particular issue that is in front of us. So we have Uganda, Kenya, TZ, Rwanda, South Africa, and Nigeria. We have various measures that we've looked at. The only country that we can say as of yesterday, the information that we have available to us that had not responded in any way from an economic stimulus or supplementary issue was Tanzania. Uganda has passed a supplementary. Kenya has passed a stimulus package. What Kenya has done is actually very interesting. They've passed a package. This is in dollars. The $80 million, $392 million. Rwanda is $54 million. South Africa is $26 billion. So you can see the scale at which South Africa is intervening. Kenya has cut taxes, but has also provided a stimulus package. So in that way, they have left some funds in the economy. They've cut back on income tax. They've raised the threshold, the lower threshold for tax to about 900,000 Uganda shillings. Anyone earning below that will not be taxed. They've gone ahead and given waivers on the corporate side too. So individual and corporate tax, I think, came down from 30 to 25%. So in that way, they have left money within the economy, but they've also provided about $100 million for direct intervention into this issue. Uganda has mostly gone with intervention on the health side. Of the $80 million, about a third has gone to the Ministry of Health for frontline staff for purchase of various purchase and support, various materials to fight COVID. Rwanda, the information we have is that the full figure has been committed to providing liquidity within the financial services. South Africa has rolled out so far the biggest stimulus package. About 10% of their GDP has been, committed to fighting. And those of you who are following know that the bigger problem, or the country that is mostly affected by COVID, is the South African economy. So they've rolled out, social safety net measures, but they've also rolled out economic measures. So they've really put so much money into keeping people at work and also supporting those who do not have any work. Nigeria so far has rolled out about $3 billion, about 1% of their GDP, and at various intervention measures. A lot of it has gone into supporting manufacturing, into import substitution. So we could pretty much say that the response has been swift and has been fairly adequate for some of the nations that have got off the block quite fast. We've seen loan restructure programs for all the countries except Tanzania. You can restructure loans. This is in line with the central bank in Uganda, Kenya, South Africa at different levels. We've seen policy rates being cut. This takes central bank rate, reserve requirement, repurchase ratios. All these have reduced. Nigeria, in their monetary policy meeting of March, did not lower any of the policy rates, but they had within that same policy meeting had already reduced the rate at which banks can borrow directly from the central bank. So many of the policy rates are constant, but there are other intervention measures. Asset purchase by the central banks. Here, we really have the central banks putting money into the economy by purchasing treasury bills or bonds that are being held by commercial banks, by microfinance deposit taking institutions, by other financial institutions. We've had an announcement to that effect for Uganda, especially on the microfinance front. Kenya, we've not got an indication. Rwanda and South Africa have opened windows to do that. We've not had similar from Nigeria. From a tax perspective, I already talked about Kenya. They've reduced tax at the corporate and individual level. Uganda, we've not had similar intervention, and neither have we in Rwanda. We've had interventions both in South Africa and Nigeria. As we get closer to home, this is how the story looks like, or looked like before the pandemic was declared. This is quarterly GDP growth for Uganda, sourced from Bureau of Statistics, and you could already tell the red graph is really the quarterly GDP growth for Uganda for the past 4 quarters. The previous 4 quarters, excluding the first quarter of 2020, you could already see that the economy was not performing as expected, even before Corona, and that is similar for many of the African economies. Nigeria, South Africa, there was a bit of sluggish pickup in terms of GDP growth. We can see the revisions started considerably before Corona hit our shores. In August of 2019, we had, and these are all sourced from the monetary policy statements from Bank of Uganda. The expectation was that the GDP would grow at between 6 to 6.3% in August. This was revised down. Between October and December, GDP growth was revised 5.5 to 6. And in April, at the April meeting, GDP growth was revised, and this is still expected because, as the CEO of UBRA said, the full impact has not yet unraveled. So this is what is anticipated for the fiscal year of 1920. GDP would end up in the region of between 3 to 4%. So we were already under some considerable strain even before the corona or the COVID started to impact our economy. These are subsectors. We thought it would be good to discuss these as they form the general economic picture. There are subsectors which at the advent of COVID, at the announcement of this being an epidemic or pandemic by the WHO, these essentially stopped. So it was a hard stop for the sectors or the subsectors in red. Tourism, because of travel that had been shut down. So we have tourism bringing in close to $1.4 billion in the previous financial year. That's foreign currency that has pretty much ceased totally. So if you take such funds out of the economy, the impact will naturally be felt. Transportation, this air and any other means of transport also ceased immediately. So these experienced a hard stop, and the impact of this hard stop was that people had to immediately go home. People had to revise budgets. People had to refund, for example, advance bookings for tourism. Labor externalization, this is coupled with the diaspora remittances. This, because it is mostly exercised through air transport, so that stopped the externalization of semi-skilled labor, especially to the Middle East. That ceased immediately. That then is coupled with diaspora remittances, and a good number of the remittances are from citizens that are not working in the formal sector. They may not be registered legally in those countries. So these do not even qualify for the interventions that, for example, the US or the UK has rolled out in terms of help. So remittances from the diaspora are expected, to reduce. Labor externalization was ground to a halt. This also brings in about $1.35 to $1.5 billion in terms of FX. So tourism and labor externalization is a very big deal. Retail trade, this also stopped immediately because no movement, lockdown. So that has also hit a hard stop. The other sectors that were brought to a halt but are showing slightly more promise is agriculture. We can't go out into the gardens, we can't do agro-based trade, but largely speaking, people have to eat, and that you could say has suffered but has not been brought to a stop. And we expect that this will pick up the minute the lockdown is ended. Education was brought to a halt, so schools are not receiving tuition fees from students and all that, but we expect that with the guidance of the Ministry of Education, this will pick up immediately. The lockdown ends. Once students are back to school, the education sector will start to see some turnover in terms of tuition. Communications, this has actually got a boost from the lack of mobility of persons. So the only way that we can communicate as we are right now is through platforms like this, through the mobile phones. So there's been a boost in the telecom sector, and we've seen numbers. The numbers that we've been availed with so far from Kenya. Safaricom has got quite a bit of boost in terms of usage, and in terms of their platforms getting good hits. So coming closer to home from an economic standpoint, we are going to look at where we invest the money. Martin brilliantly put out where these funds are lying. Those of you who saw the tables, a lot of the funds that we are managing are under fixed income. So we have, to your left, we have a chart or three charts that talk about interest rates and the movement of interest rates over the past year. There's a chart talking about inflation, but even if you do not interest yourself too much, I will be able to explain what is going on here. The interest rate chart essentially shows very little difference between 31st March of 2019 and 31st March of 2020. And that takes into consideration COVID-19, because it started in February. So you could say for your fixed income portfolio, in terms of yields, there will be just very little volatility. The curves that you see varying, for example, in the red graph, in the green graph, but directionally you see that the direction looks pretty much the same. We got a bit of a shock when foreign investors were selling their bond holdings. That's in February and in March, and that caused interest rates to move up a bit. It affected the currency, the 2.2% that the CEO talked about. But I think by and large that is past. So we're seeing a fairly quiet, fixed income frontier from where we were in February. Inflation has barely been affected by the impact that we're seeing, at least the inflation numbers of beginning of April or end of March. This is still fairly steady. We have support from food production, which we expect to continue if the rains that we see now continue. We have a very good underpinning, especially on fuel imports. Those who are keen, or those who have seen global oil prices have plummeted. This is expected to support us on the fuel import bill through the next 6 months. A barrel of oil is not going to be, or we don't expect it to be above $50 over the next few months. Right now it's trending at about 25, and that's for delivery within 2 months. So we expect inflation to remain, it shouldn't be a concern at this point. How that affects your scheme is that the savings that you have as of this point are not being eroded at a rate more than what you're earning off those savings. So the real return or the real value of your savings is still being protected. We have a lot of comfort from fixed income. However, the pain that we are seeing is from the equity side, and this is information that we have again gathered. A lot of it is from Bloomberg. We have exchanges. Again, we used the same countries that we started with from the macro. Year to date, which is January to April, we have 1 year performance, we have 1 month. And the 1 month performance will offer some hope to the members on this call. Jan to April, this is, end of January, the markets were, fairly well priced. There was a lot of optimism. The rate cap had been lifted in Kenya. We were seeing banks within Uganda, starting, to churn out impressive half-year numbers and full-year numbers. And if you look at the stats from the released financial statements, you'll find that the banking sector had up to December done, fairly well. Come the sell-off. What happens when WHO declares the pandemic? Investors, especially those that are not based in East Africa, take that as a sign to convert their asset holdings into a safe, safe destination, safe currency, safer assets. What they mean by safe assets, incidentally, is US dollar denominated assets. In this case, US dollar treasury bills, US government treasury bonds, and you would not imagine US dollars, the cash itself. So you had many investors sell their equity holdings, sell their bonds within Uganda and Kenya, and convert these funds to dollars. And that's what affected, one, the currency, because a lot of money was moving out of our economies. So the demand for dollars was elevated. And also, it pretty much was a fire sale on a lot of the counters. We have the NSC, where the NSC and the USC is where most of the equity holdings are for the Ugandan pension schemes. Between Jan to April, the NSC 20, top 20 listed companies lost about 25%. But we also felt it would make sense to look at the 1 year. The 1 year is really before COVID, so that we try and distinguish, is everything related to COVID, or do we have some other underlying issues that we are just hiding under COVID? So you have from NSC, DSC is Dar es Salaam Stock Exchange, USC is Uganda, JSC is Johannesburg, and another NSC is the Nigerian Securities Exchange. There seems to be very high correlation in terms of performance. Jan to April, negative, double-digit negatives. On a 1 year perspective, again, South Africa has been struggling. Nigeria, the economy has been struggling. USC has had some specific issues in terms of market capitalization. A couple of companies have reduced in value, some of which cannot be explained by their fundamentals. So this is really market sentiment. Dar es Salaam on 1 year is at -6. NSC 20 is at negative 24.8. So you could say that for the NSC 20, a lot of this is really COVID related. There's some hope, however, if you look at the 1 month. So this 1 month is yesterday to 1 month back. So we got this to also see how bad is the impact of this, of this sell-off. And this has happened pretty much in most of the markets globally. There was a sell-off, a panic sell-off. However, some investors felt, stocks had been, unfairly sold or punished, or the panic was not precedented. Or from some of the responses that we're seeing from the governments in the US, in Europe, even within Africa, some confidence was restored. So you see, in the past month, we're actually in positive territory in Nairobi, negative in Dar, pretty much flat in Uganda. Johannesburg is at positive 25. So that is really a big move up because of how far down they had gone. Nigeria is at positive 4%. I'm really at the tail end of my discussion. To summarize expected impact, fixed income is expected to remain stable to give you the sort of returns that you're expecting and used to, and this was alluded to by the CEO. For those of you who are running amortization or held to maturity portfolios, that return will actually improve slightly. Shorter term treasury bills, we still have double-digit returns from treasury bills. So for 70 to 80% of your portfolios, that is expected to weather this COVID storm, fairly well. The real issue is on the equities, with the volatility that has come in and that we continue to see. Is it is it a V-shaped, kind of recovery where it's a quick bounce off the bottom back to where we were? Is it a W where, the optimism that we're seeing now may disappear within another 3 months? Or is it a U? There's so many of these shapes that have been put forward to try and predict the performance of equities. Where I can give you hope is a lot of the funds that you've invested in the equities space. A lot of these companies are reporting their 2019 financial year results. A lot of them did well on a fundamental basis. At least I can speak for the banks. And some of them will still pay dividends. There's been a policy guidance from the Bank of Uganda for banks within Uganda not to pay dividends and bonuses. There's been nothing similar in Kenya. However, we've seen some of the banks there instead opt to issue more shares as opposed to cash, which makes sense because this is a time when you need to be cash rich, or you need to manage your cash flows because there's not a lot coming in, so you need to restrict what is going out. But many companies will still be able to pay a dividend one way or the other. So your holdings already have earned you that, and that's good news. So the downturn is not all bad. The second, for those who have the appetite for risk, and many long-term schemes really do have appetite for risk. This has been, and for some of our clients, we've had discussions with them to say this is the lowest we've seen these equities for a very long time. Should we pick up? And from a strategic perspective, 2 year, 5 year down the road, we've picked up some equities at the levels at which there are some schemes that are fairly risk averse and have requested to hold off. But what we're doing really is to engage with the schemes, to engage with the trustees, to tell them, those of you who are our clients, we've issued about 3 communications, a profit warning for pensions. We've issued where your portfolio lies, how it's looking like right now, where are your assets. And we say, you have very few equities, there's nothing for you to worry about, or you have a fairly large holding of equities, this is what we are proposing to be able to benefit from this. Maybe we should buy more, which sounds very crazy to some people that anyone would be buying more now. But this for many people is the time to buy. So we've stayed in touch with the schemes. What is going to happen going forward? IPS is going to be reviewed from a strategic point of view, investment strategy. That's open to the schemes. What is critical is that you stay in touch, very close contact with your fund manager. Ask them where your money is invested, what the plan is to weather the storm. There will be some pain already from the performance you saw a couple of slides back. If you had invested in equities, you cannot avoid the negative 20s or the negative. But now that you have that unrealized loss, what do you do with it? What advantage can you take from sitting on such a position? Because unless you are hard for cash, selling right now is possibly the worst thing that you can do, or it's very, very suboptimal, unless your scheme is really pressed for cash. So there will be a lot of discussions between the managers, the trustees, the members. I think the sponsor is a very critical player now. They are back in the game. Before, we used to talk about trustees only, but the sponsor, some sponsors will downsize without a doubt. So it is important that the plans are communicated prior. Trustees need to talk to the members directly. Trustees need to stop going through the service providers. They need to communicate to the members. This is what's happening. This is what we are seeing this year. The sort of returns you got over the past 2 years may not be possible this year. However, this is the plan we have going forward. Thank you very much. I've used up considerably more time, but I thought it would be useful to just expound on what I had to share. Thank you very much. Over to you, Bansi.
Thank you so much, George. Yes, I think that was quite insightful. I'll request the participants, if there's anyone with a question, please raise your hand and I'll allow you to speak, or if there's anyone, or you may use the Q&A function. I can see a question from Amani. He says, since Uganda is expected to go for campaigns in 2021 and elections thereafter, a period the investments will be recovery, how best can the scheme's investments be repositioned after COVID-19 to provide a positive trend of declared interest to its members? So maybe you may answer that, George. What do you think we should do next?
Thanks, Amani, for that. We have, without a doubt, an election year coming. The structure of the campaigns has not yet been communicated because, to be honest, we all don't know how a political campaign can be held in this particular environment. So, how do we one, protect the schemes during, over the course of the next 12 months? And also you mentioned something about a positive trend, going forward. I'll address the positive trend first, then I'll look at protection of, of scheme assets. The obsession or the expectation of many of our members is that, year on year there should be growth in terms of the interest that is declared to them. I think there's a lot of information sharing that could happen between ourselves, the trustees, and also the members, to know that if a scheme is invested in an economy where there's a knock-on effect of a pandemic, and that economy is not doing well, the expectation is that your investments will also be hit. When the economy recovers, you will see that directly in the interest that is declared to you. So there's a lot of managing expectations, especially around interest declarations for this year, possibly into next year. I don't think we should be shy about it. If everyone is working at home, then there's something wrong with the economy. We couldn't possibly all be home because everything is normal. So it is okay to also communicate that this is what is happening to the economy, and it is going to affect you negatively on your return. So that message needs to go out. It needs to go out early and clearly so that it is received and incorporated. Protection of assets over the next 12 months. I talked about fixed income delivering fairly decent returns, both short-term assets, long-term fixed income between 12 to 16 is what we're seeing. That in of itself, if you have 80% of your portfolio allocated to that, you'll get a lot of protection from the volatility. Some funds are buying more equities, and those are the ones that have appetite for risk. Some funds have stopped buying equities. That is where the risk probably, the willingness to take on risk and the ability is a bit reduced. So you're really playing with the equities asset class. You could buy more, or because of the opportunity that exists, or you could stay your purchases so that you are not any more exposed in case there's volatility, further down the road. So I would say many of the schemes, if you have 80%, 70 to 80% in fixed income, you have a fairly good buffer. Thank you. Thank you, Bansi.
Thank you, George. Another question. Currently, trustees and service providers are working from home. This presents heightened threats to the cybersecurity of schemes, including member data and benefit payment processes. What particular risks that working from home might heighten present to the protection of member data and benefit payment process? Are there proactive measures which can be taken to reduce those risks? So this is from Cosmas. And I think you may answer this, and I'll also request my Uganda team. I see Alice is online. Maybe she may want to chime in. And then we have Ben, who also asks that some schemes are already in reactive mode for COVID-19. This makes them not be in charge of their investments through contribution. What advice do you have for them? And then finally, there's a question by an anonymous attendee. They ask that the impact is still fairly being felt. However, in a long run, with a lot of uncertainty in the private sector, fundamentals will most likely be bad. How long should expectations be on upturn of the fundamentals? I'm not sure whether I understand, but please go ahead.
Thank you, Bansi. Member data, payments process, investment process. I will address the investment process, and someone from NWealth could help with member data and other similar. So what we did, the truth is that the lockdown was not a sudden or abrupt event, especially for Uganda. You got the feeling 2-3 weeks before the lockdown that it was coming. You have all these countries stopping travel, you have stopping of public transportation, or first restricting, then stopping public transportation, then another couple of weeks. So within that time, just for business continuity, we had run various scenarios where if we cannot go into the office, how do we continue to work? How do we continue to invest the funds? And we had reached out to the custodians and shared our concerns, and the custodians had provided channels in which we can communicate, investment instructions, in which that are secure, because what we still do when it's business as usual is we forward instructions to the custodians, who then execute them. So we essentially tested this process before the lockdown happened. We were satisfied that the process was secure, especially around confidentiality, and by the time the lockdown came, we were really ready to continue investing on behalf of the clients. I will address the other two, then allow maybe NWealth to comment on benefits. Many are in a reactive mode. Yes, there's, and this has been alluded to by the previous speakers. Matters of cash flow, matters of liquidity, right from the sponsor will certainly flow into the scheme. Benefit contributions, things of the sort. At the time, not many schemes have fully assessed, how, the sort of impact that this is going to have on their cash flows. However, we have a very open channel straight to the regulator, and the regulator has given these assurances that, look, if you're facing challenges with any of the regulatory positions or requirements, please talk to us. If you have no money because you've not been in business, therefore you can't contribute, bring this to us with a plan. If you would like to stop contributions, if you would like to review trust deed and all that, I think the regulator has really opened that door so that there's no need to overly panic. If the sponsor is going through a tough time, I think they just need to be open to the regulator, but also to the members that, this is what's happening, and because of this, these are the steps that we are taking. Uncertainty, the impact is still unraveling. And I don't know of any economist who would tell you that by 1 year or 2 years or 3 years, this will be fully behind us. So we have the market reaction, which is very volatile and many times short term. The markets will respond just to news. However, after that response, we then have the economic response, loss of jobs, downsizing, you have layoffs, you have government programs that are coming in to support employers to keep people in work. And that that transmission to the main economy from a stock market is, takes a longer time. It requires confidence to return, especially from the consumer side. Businesses to start paying taxes, governments to get back onto the programs they had before. So that will take the markets. We expect that the minute lockdowns are ended, if there's positive news on a vaccine or things like that, markets are expected to recover. However, the market that will not recover are those then that are related to the economy. For example, the banks are major transmitters of economic policy. So the bank stocks will take a while to recover, because it will depend then on the performance of the whole economy and the sort of recovery of businesses. So we really can't put a timeline. All I know is that the stock market will rebound faster than the economy, than the rest of the economy, and that we have not yet fully seen the impact. On opening up, we could have a rise in infections, closing again, and all those are possibilities. So really, we can't address that at this point in time, in terms of uncertainty. That is with us at least for the next 12 to 18 months.
All right.
Thanks,
Mr. Nsubuga, I see you had raised your hand. Would you wish to speak? Just a second, you're on mute. Let me unmute you. Able to unmute your speaker, sir? You're on mute.
Yeah, okay, sorry. No, I just wanted to make a few clarifications, and probably I don't want to George has said. The suspension of paying bonuses and dividends by the central bank, it is for 90 days. So we anticipate maybe after the 90 days it will be restored. And the understanding we have, suspension does not mean don't pay, but rather delay the payment after 90 days. So we anticipate it will anyway be paid. But I wanted to add to the fact that the sponsors are going to play a big role in this period round, particularly for our occupational schemes. And I wanted to provide some clarification on what I'd said earlier, particularly on the question I think that Meta raised, what would happen if there is a suspension of payment of contributions. There are three categories I thought I needed to clarify on this. The first category of consideration is when the employer just suspends payment of contribution, but they are willing to honor that obligation in future with a clear plan of executing that. That is pretty okay. Again, we shall engage them and have a clear plan that will be approved, and we need the assurance of a going concern. The second category is where the sponsor has opted to suspend salary payment completely. I say this period in time, we are not working, we cannot pay, we don't have money to pay. So we cannot demand contributions. Contributions are based on salaries. The base has been impaired, so you cannot demand contributions in such circumstances. So we shall assume that during that period in time, there are no contributions made into the scheme for members, for employer and employer, on the basis of no salary payments. And that will be known. For how long? What we need, that position has to be issued by a notice. You need to notify us, and then we'll be able to clarify on that. Again, it's on a case by case. The third one, which is the final one, is a unique case where some trust deeds have had provisions where a sponsor opposition, the sponsor can just provide that notice to the scheme, to the members, and of course, as UBRA, stating exactly that within this period in time, we are suspending contributions. They can just use the provision, the trust deed, and exercise that and provide the notice to the members. I thought I needed to provide those three categories of where the discussions are going to be based on. But again, like I've said, these are going to be on the case by case, we cannot publish this in the media as a policy guideline, but rather we are inviting any affected entity that we are available for discussion, and I think we can be able to have a solution to this. Finally, we don't see any risk on our side. I would say that we've not anticipated any risk to any scheme at the moment. Even the cases of the three categories I've mentioned about do not necessarily mean that a scheme is going to wind up. So we don't anticipate that, at least in the short term. That's the best assurance I can provide. Over to you, Nancy.
Thank you so much, sir. And I think for all the trustees who are present, please do feel free to get in touch with UBRA should you require, assistance or advice, as the CEO has mentioned. I think we'll come to a close. I'll invite my colleague Alice to just unmute herself, and she'll give us a brief overview of who NWealth is and how you can get in touch with us. But as we wait for her, there was a question about security when paying members' benefits. So for us at NWealth, we have an online system that's fully encrypted end to end, such that the data is stored in the cloud, and it has advanced security features. So it's not prone to things like, say, hackers. And since it's cloud-based, the data isn't on, say, someone's laptop. So even if they're working from home and they lose a laptop or someone else gains access, we don't have the risk of members' data getting into the wrong hands. Also, in terms of backup, backup is done both in Kampala, in Nairobi, and in South Africa. So in case, God forbid, something happens and one of our data centers is affected, at least we have 2 other backup spaces where the data is stored, and so we are assured of the safety. Now, I'll just share a brief presentation on who NWealth Financial Services is and some of the services that we offer. Now, just give me. If Alice or Brian are available, they can speak to it, but NWealth Financial Services stands for Enabling Wealth. It's a short form for Enabling Wealth. Some of the services that we offer is fund administration services, which is our flagship product, and we are doing this in Uganda for our clients. We also have consulting services for retirement benefit schemes, training services, as we are doing now. We look forward in the future to set up an insurance brokerage arm and offer also corporate trustee and property services. We have several flagship products, and our key product within the markets right now is a Uganda Umbrella Retirement Scheme. This scheme allows individuals who don't want to set up standalone schemes and would wish to be part of a larger pool just for the economies of scale to join in, and their benefits are managed within a bigger pool. If you wish to get in touch with us, we're on 5th floor of Nakawa House UAP Business Park, plot 7 on Port Bell Road. That's our PO box. You may email us on you may check us our website, on www.nwealth.co.ug, or email us on info@nwealth.co.ug. Thank you all so much for joining. I think we'll call it a day, and thank you for indulging us. I think we've gone